the syllabus. The syllabus includes investment appraisal. The second section is mergers and acquisitions. Second section. And I will add another section to it, that is reconstruction. And the last one, that is the risk management. And we can add some theoretical topics as well. So some theoretical areas. So this is the whole syllabus of AFM in front of you. Merger and acquisition and reconstruction, I normally club these both together because their knowledge is interchangeably utilized. Investment appraisal includes WAC as well. In financial F9, you study WAC separate topic. But here WAC is part of investment appraisal and advanced investment appraisal as well, international investment appraisal as well. So investment appraisal is around 35% of your syllabus. This is again 30 to 35%. And same is here. So 10%, you can say 5 to 10%. Now, this is what your syllabus is. And in exam, we know there are 3 questions in exam. Question 1, question 2, and question 3. 3 questions are there. Question 1, 50 marks. It is normally a hybrid question covering 2 sections normally of syllabus, which may be from investment appraisal plus risk management, or risk management plus merger acquisition, or any combination they can make. And then question 2 and 3, normally they are more focused from one area. Yes. AFM. When we talk about AFM, we can say that the syllabus AFM, AFM exam. First of all, we need to learn conceptual clarity. And that is utilized in the calculations, first of all. Calculations of NPV, IRR, MIRR, APV, international and Black-Scholes option pricing theory, risk management questions, valuations question. So calculations. Here comes where student normally lack, that is discussion. Utilizing that calculation and information in scenario. Yes. So 2 types, remember. So if you find a 50-mark question, so out of that, it might be 50-50. Some discussion and some independent. Discursive questions. Yes. Discussions, related questions on scenario. They cannot be generic question. Again, it will be utilizing your overall knowledge of financial management. You need to apply to scenario. What is wrong with the student? That they miss scenario altogether when they're discussing. So remember, professional exam, when we talk about professional exam, you are writing any professional exam, you can't miss do discussion. Generic. Which is generic? Your answer must be written on scenario. This is professional exam. Okay. Now, and all professional marks, they surround around it. That's why normally I say students that they say, Mr. Hamzah, there are 80 technical marks and 20 marks which are professionals. I ask them 80 technical marks if basically these 20 professional marks are not something additional to be done. You have to demonstrate all these skills in doing technical answer questions. If you do that well, if you write answer properly, discuss that properly, discuss data, talk about scenario, automatically you get professional marks. And it happened. This is what examiner says, not only me. Okay? So students keep memorizing what is commercial acumen, what is professional skepticism. That is not to be memorized. That is to be demonstrated when writing answer. Memorizing something and demonstrating, that is different. A person is saying, so you talk about swimming skills. A person start giving lecture how to swim, what should be the dressing, how the body movement. The other person jumps into water and shows you how to swim. So which one is better? The person who is actually demonstrating it, every technique. The person who has memorized techniques jumps into water may forget to apply. So this is the difference that need to be kept in mind. I hope you got it. Now, so let us proceed further. So we will be starting with, I have to share with you the volume one of the notes. Don't you worry, I'll be doing it today itself. Don't you worry. And not today, maybe within just one or two updates I need to check. Although syllabus is not changed. So I'm just rearranging some data. Syllabus is same which was the last year. For the next 1 year, the syllabus is same for AFM. So previous exam kits, previous study attacks, whatever it is that is applicable. No need to buy new if someone has, you have got it from your friend or someone else. Okay. I will also be sharing with you the kit as well. Now, so we need to start investment appraisal. Why I am typing? You might be thinking, I have my iPad with me. I can write just like on the board. You see, the reason in AFM, the typing is, the reason is one of, because each topic involves calculations and the calculations are done in exam in such sheet which is similar to Excel. So I will be sharing with you this Excel sheet after the class so that you can save it with you, you can review it, and it's in the real exam field we are studying. So that now, so let us proceed further. So we are starting investment appraisal section. Investment appraisal. Investment appraisal is a huge section and it normally takes 1.5 month minimum to cover. So, first of all, it has investment appraisal techniques, the first part. The second part is adjustments in investment appraisal. Then comes the third one, that is WAC, which is part of it. So basically three sections we can say. So techniques are payback period method, ARR, accounting rate of return or ROS, discounted payback period method, IRR, MIRR, duration I missed. I was thinking I missed one. Yes, duration. MIRR. Then is APV, adjusted present value. Then is international investment appraisal. Okay. Then comes adjustment, sensitivity analysis, sensitivity analysis. Then comes probability or expect probability analysis or expected values. Then simulation. Basically, this is risk and uncertainty in investment appraisal. These topics are risk and uncertainty in investment appraisal. Then comes capital rationing. So that when you have limited funds, but you have to choose from out of the number of uh, we can say available projects. Next, the next point is WAC. So WAC has multiple dimensions. Very detailed topic it is. Very detailed topic it is. Big topic here. And then WAC, first of all, cost of equity, cost of debt, then risk adjusted WAC, capital structure theories. Then there are yield curve, yield curve, and credit rating of bonds. So this is investment appraisal, the whole section. And it is very interesting. It will become interesting if you are regular in your studies. Otherwise, it will become something nightmare. If you miss class 1 week and you come to the next class, what will happen? You have missed the linkage between the two lectures. And you might be getting 30-40% then while sitting in the class. So remember the Sunday class in the morning, we kept deliberately this time for AFM that almost everyone is free at this time who has to attend AFM. Okay. Remote chances are there that someone can get some emergency. Okay, so starting with investment appraisal techniques. So that these techniques we will be discussing today itself, all these. That is the topic for today. Now, so let us start with the payback period method. What is payback period of a project which is to be launched? We are appraising project. Appraisal techniques are to appraise a project company is thinking to undertake. We have to decide today whether this project should be undertaken or not. We have to decide about it today itself. So payback period method of investment appraisal, actually it talks about, it is the time to be taken to recover initial investment of project. That is called payback period. Time taken to recover initial investment of project. That is called payback period. Now, that is what any investor interested in. That I'm investing 10 million today. How much time it will take to get back to me my initial invested amount? I may have to borrow that money. I may have collected that money for, I may have to invest that money somewhere else after a certain period of time. So payback period. For example, initial investment of a project is 120,000. And annual cash flows, net cash flows is expected from it are 20,000. So what is the payback period of this project? Total investment, annual recovery is this. So 6 years. Now the point is whether this 6-year payback is acceptable or not. If it is higher than our target, we will say, sorry, we cannot proceed with it. That's it. Cancel the project, reject it. For example, our target was that we have to recover funds in 4 years. We cannot undertake this project. Simple. At the first spot, it failed. No more discussion on it. Yes, practically talking, cash flows of the project are like this. So here, year 0, 1, 2, 3, and 4. For example, initial investment of the project is here. That is here. And cash inflows are expected to be like this. Varying cash flow inflows. Now, what will be the payback period of this project? These are the net cash flows of project over 4-year life. So how to calculate pay? So cumulative cash flow, we will calculate cumulative cash flow. Cumulative means total to date. This here, this brought forward negative and this inflow. So total to date are negative 760. 1,000 was our outflow last year, 240 inflow. Total to date, this till now here it is. Now out of that 390 recovered. So total to date in 2 years are negative 370. We need 630 here, 370 here. But how much they are year 3? 630. It means part of year 3 will be required to recover this 370. So 2 year complete and part of a year 3, how much? 370 needed divided by 630. This part of year 3 will be needed to recover this amount. Once again, 370 needed. And in year 3, total cash flows are much higher. So it means year 3 fully will not be utilized to recover this amount. Part of that, this part. So 2.6 years. You can see if you round it off. 2.6 years. That is the payback period of the project. Now, next comes, but this payback period method has a drawback. The drawback is that it has a drawback. It does not consider time value of money. No discounting, you see here. All cash flows which are occurring in year 2, year 3, they're considering to have same value. They're being considered to have same value, which is wrong. It does not consider whole life of project. It is concerned with small part. What is happening after 2 years or 3 years, it ignores. So two projects with the same payback may have different total cash flows, which is not considered. So payback will not be able to give a decision which one to choose, as it does not consider what is happening after payback period. I will give you example, don't you worry. So let us talk about the example. This is project A, this is project B. This is year. Year 0, 1, 2, 3, and 4. So for example, investment is 1,000 in the both cases. So 300, 400, 300, 200, 100. 200, 600, 400, 300, and 250. Now these both projects, if we calculate payback period, both have payback period of 3 years. 3-year payback period. Same investment. Now which one to select? Which one to select? Payback period is silent. It is not telling anything about that. It is not telling anything about that. It is on silent mode. So then what to do? That is the point. So after payback period, it is giving 550. It is giving only 300. Payback period does not talk about that. It ignores it. That is the point. Now, yes, there are advantages as well. You can say, okay, what are the advantages of payback period? Mr. Hamzah, you didn't talk. Yes, we can talk about that as well. Advantage is that it is cash flow based. It, yes, it reduces the risk of business. How? By recommending short-term projects. Risk of business is reduced because it says accept that product which has shorter payback. And that's it. Now, the next is accounting. Okay, right. So there came discounted payback period. Discounted payback. So this drawback, the first drawback was removed by it. They say, okay, you have a project. I'm going to take the same cash flows. Cost of capital is 10%. So you calculate present value of cash flows first. How to calculate? We know the formula. Present value is equal to future value into 1 plus r raised to power minus n. This formula we have studied since long. We have been studying. Now, so the point is this into 1.1 plus 10% to the discount rate raised to power minus n. Same formula I applied. I dragged it. Yes, very easy. So now cumulative cash flow column, we need to a column row over it, present value, total to date, this recovered, then this recovered. Now we need 459. Here is present value 473. So 2 years complete. So 459 divided by 473. 4 around the whole year 3. So 2.97 years is the discounted payback. So only one problem removed, this one. All others are here. Then came the concept of duration. Duration. Now, duration is basically weighted average time to recover present value of cash flows of a project. Weighted average time. Now, what it is, I will explain it by calculation and then further interpret that. So how duration of a project is calculated, same cash flows I will take and we will be doing it. Okay, I'll take the same example. These are the cash flows and their present value. So first of all, the first step is step 1. Calculate present value of cash flows. We calculated already. So total present value we will calculate. Just delete year 0 because it talks about inflows after investment. It talks about that. Now, present value of cash flows of a project. Now, let's see here. Sum from here to here. Total present value. Now, weighted average this divided by this. So this divided by total. Yes. And this by this. So weight of each item to total, each present value to total present value. So calculate, step 2. Calculate weightage of each present value to total present value. Yes. Now, the last, step 3. Multiply each value fraction with relevant number of year. Yes. Each value with relevant number of year. This into this number of year. Like this. Each weightage with the relevant number of year. Now, so what is duration? Add all. $2.85. So step 4, add all amounts to get duration. This is the duration. So 2.85. So what this number explains? This is very much important. It is weighted average time to recover present value of cash flow for project. What does it mean? Remember, if duration of a project is more than half of a life of a project, half of life of a project, of the project, its major cash flows are in its later years of life. So 2.85. What is life? 4 year? 4 year life? So half of that, 0.5, 2 years. So duration, 2 years is the half. Our duration is 2.85, much higher than that. Much higher than that. So majority of the cash flows are in the later years. This figure tells, we can verify it from here. You can see. Initially, small, major cash flows are later years. Is it clear so far? Tell me. Is it clear? Duration is clear? Tell me. There should be some response from your side in the chat box. Right. So duration actually, it removes all drawbacks. It considers time value of money. Thank you. It is cash flow based. It considers whole life of the project. So everything is covered. Yes, one point is it is difficult to understand. We can say that. It is difficult to understand. Duration. Okay. Just give me 2 minutes. I will rejoin. Okay. We'll continue. The next topic is accounting rate of return. ROS. Just 2 minutes. I'll be Yes, students, accounting rate of return, ARR, it is also called ROS as well. Return on capital employed. This is the only technique, only investment appraisal technique which is based on profits. The only investment appraisal technique is based on profit. All other are cash flow based. Do you know what is the difference between cash flow and profit? So basically, when we calculate cash flows of a business, we deduct from them non-cash expenses. We get a profit. Non-cash expense, for example, depreciation, amortization, okay, which are not cash paid in cash. Their estimation and systematic allocation. Okay, now. So accounting rate of return, ARR, how it is calculated. So ARR has a formula. So it is basically average annual return given by investment. Okay, in the form of profit. So ARR is calculated. Two formulas are there. Is equal to average annual profit divided by total investment, initial investment. But there is another formula. Divided by average investment. And this is more acceptable formula, more widely used. And I will prefer that as well. Unless if examiner asks you calculate with initial investment, you will always use this. So what is the average investment? That is equal to initial investment plus scrap value divided by 2. Initial investment plus scrap value divided by 2. Now, the next point is, for example, let me take the same, yes, cash flows. For example, scrap value is of the project is 100. And I'm going to reduce it 430 and okay, 370. We need to calculate ARR. But for that, we need, first of all, profits. We cannot calculate with cash flows. And for that, we know that cash flow minus non-cash expenses is profit. Okay. So what are the total cash flows of the project? Starting from cash inflows I'm talking about. Here they are. So what is the non-cash expense? Here. In this case. So non-cash expense is depreciation. So depreciation of machinery. How much is that? Initial investment is 1,000. Scrap value is 100. So difference is the depreciation. No? Initial investment is 1,000. Value at the end is 100. So what is there is a difference? Depreciation. So now total profit. This minus, minus this. So total profit. So average annual profit can be calculated. This for this average annual profit. So total profit divided by life of the project, 4 years. Life of the project is 4 years. Average annual profit is here in front of us. So now we need average investment. What is the formula? We studied initial investment plus scrap value divided by 2. So initial investment plus scrap value divided by 2. 550. What is the ARR? What is the ARR? This divided by this. Average annual profit divided by average investment. Any confusion, any problem, feel free to ask. So accounting rate of return. So we say that if ARR of a project is greater than target ARR of company, target ARR is decided by the board of company. We say accept the project. Otherwise, we say reject it. If it is less than that, we say reject it. What are the drawbacks? First of all, it is profits based, which can be manipulated. You can add or decrease amortization by your own self, your own estimations, other non-cash expenses. Okay. So second, it ignores time value of money. No discounting, no, nothing like that. And very important, it is a relative measure and ignores the size of project. Don't you worry, I'll explain. Ignore the size of the project. What does it mean? Come here. Two projects, A and B. Their ARR 30%, 39%, and 25%. Which one should be selected? Which one should be preferred? You will say A. Relative measure, percentage is a relative. So percentage is a relative measure. It's saying, but the point is, for example, investment is here 20 million and annual profit is 4 million. Here investment is 2 million and average annual profit is 300,000, 0.3 million. Now, see the difference. Very small project, Amounts are small. Amount of profit is small. So this is the drawback, that based on it we cannot differentiate. We say, okay, take part A. Oh, very small when we go in detail. So ARR does not tell the size of the project. It talks about a huge percentage only. Is that clear? Now, next. The next is NPV, net present value method. So, net present value, NPV, method of investment appraisal. So, NPV, net present value, the name tells. Calculate present value of cash inflows, outflows, and net that. So, NPV, the name tells net present values. So, present value of cash inflows minus present value of cash outflows. Simple is that, initial investment. So basically what it tells, very important. So NPV method tells the exact impact of a project on shareholders' wealth. Now, what does it mean? Listen, I have my this wallet with me. This is empty. I put $10,000 in it. Borrow from friend, put in it. Now I go for business to do business with it. I run business, purchase material, everything, pay from it, then make sales, put amounts in it. So sales cost, everything is being paid from it, then I'm adding it to it. And at the end, what remains in it, that is the net cash flow. That is the net cash flows in this wallet. Then I say, okay, since it will happen over years, 1, 2, 3 years, I calculate present value. Net cash flow in the year 1, 2, 3, 4, 5. Okay, so time value is deducted. Then at the end, I pay this negative from it to my friend I borrowed from. Now, after paying this, still there remains 2,500 remaining in the wallet. So what is it? This was empty. I paid everything, paid initial amount, still 2,500 remaining in it. Who they belong to? Tell me now. This is my wealth. This wallet was empty before. I borrowed money, invested, paid all expenses, costs, inflows, outflows managed, calculated cost, present value, and then paid initial investment back to the lender. Now, this is the my wealth has increased by this project. This is NPV. Scenario 2. If the time comes to pay 10,000, I want to pay 10,000. Scenario 2 is that the wallet does not have 10,000 now. Wallet has, for example, I can only pay 8,000. Here, I have to pay 10,000. So how much is shortage in the wallet? 2,000. This now I have to provide from my other sources, selling my furniture, iPhone, God forbid, from other funding from other sources. So because of this project was flop, it couldn't pay its cost and couldn't repay its at the end its investment. So wealth decreased. NPV is negative this. So that's how impact of a project on shareholders' wealth. Okay, that's why we say when NPV of a project is positive, we say accept the project. Why? Because it is increasing shareholders' wealth. It will increase wealth of shareholders. And if it is negative, we say reject it. And it will decrease the shareholder wealth. And NPV is very good method. Advantages. It has all advantages. Cash flow based. Considers time value of money. Considers whole life of project. Considers size of project. And tells exact impact on wealth. So it is called absolute measure it is. Yes. Size. How much is the investment? How much is NPV? Amount. NPV. Yes. Changes in cost of capital through the life of project. Can be incorporated in it. For example, first 2 year, cost of capital is, let me put this data. This is a project. Cash flows. Cost of capital for first 2 years, 10%, 20%, 20%. Okay. Then it is 15%. Then it is 17%. Okay. 17%. So it can be incorporated. Just see here, present value. Here 20%. This into 1 plus R raised to power minus this. You see here 17%. It is calculated on 17%. It is calculated on 17%. It is calculated on 15%. It is calculated on 20%. So changes in cost of capital can be incorporated. Now you can calculate NPV very easily by considering the change in cost of capital. Now, the next point. If there is any confusion, you can ask before I proceed. Now, the next point is internal rate of return, IRR. IRR is actually annual. It is the average return on the project considering time value of money. You may have said it is the rate at which NPV becomes zero. Yes, that is also a definition. But I don't like that definition. To be told at start. That will be discussed, of course. So IRR is basically what project is yielding. Now, same project. This is the project. Cost of capital is 12%, for example. So IRR. Now here in AFM, you need to not to memorize formula. You simply apply this formula. You need to memorize that how to apply this formula. Very easy. 29%. So project is yielding 29. These are basically net cash flows of project. We know that. Project is yielding 29%. Cost of capital is 12%. So IRR is greater than cost of capital. We say accept the project. Otherwise reject it. Otherwise reject it. Any confusion? Now, so the next is the next point is the IRR has drawbacks. Drawbacks a lot. First of all, it is a relative term again. Same issue which that was with ARR. Because it doesn't consider time. This percentage doesn't tell how much investment, how much return. It is a relative term and ignores size of project. A very important drawback. That is the reinvestment assumption of IRR. What is it? It assumes cash flows are reinvested at a rate equal to IRR, excess cash flows. These are excess cash flows every year, net. It assumes that this is being reinvested at, because they are excess, their project doesn't have further space to be invested in it. That's why excess. They say you can reinvest it somewhere else at 29% for next 3 years. You can reinvest it for the next 2 years at 29% somewhere else. You can reinvest it at 29% for 1 year. Wrong. Now, so this reinvestment assumption is incorrect because we may not find another place to invest at same rate of return. And it may not be possible to find a project with similar returns, especially when current project has a high IRR. Not every project can be successful at the same level. Now, the next point. The second point which I want to discuss about that is multiple IRRs or no IRR. Another drawback that when in case of a project with multiple negative cash flows in its life, there may be multiple IRRs, two IRRs, multiple, two, or no given by spreadsheet. Yes. Hence, this is error. For example, you calculate IRR for a project with multiple negative cash flow. A project may have in its life the net cash flow may be negative in the third year, in the seventh year, in the eighth year. For example, two IRRs given are here 30% and 11%. Now, cost of capital is 15%. Now tell me, you need to accept a project or reject. One IRR is 30%, which say, okay, accept it. But the other is 11%. Which one is reliable? Or sometimes it's an error, cannot be calculated. So these two errors were there. So here came a modification to it. That's why it is called modified IRR, internal rate of return. Now, so what is MIRR? MIRR fix the problem of reinvestment and multiple IRR. For example, we take this same project, cash flows. Just see here. So MIRR. Okay, one thing I forgot to tell. For example, cost of capital is 12%. And you feel like that you can reinvest these excess cash flows at 14%. You can do that just above the cost of capital. You can somewhere invest that. So MIRR is equal to, again, MIRR formula. You need to memorize it. Comma, this, comma, comma, cost of capital, comma, reinvestment rate. This is suggesting it. You see here. Excel is suggesting it, but your exam platform does not suggest it. You need to memorize it. MIRR, we will take all values, comma, finance rate is cost of capital, comma, reinvestment rate, bracket close. Once again, you can see MIRR. Any confusion? MIRR is done. MIRR is done. Now, students, we started with, so MIRR has all the drawbacks of, only one drawback, it is relative term. Now, we have covered all these methods. Now, yes, adjustments. I will add adjustment of inflation and taxation. Okay. We have time. So I will be doing adjustment of inflation and taxation, but I'll take again a 5 minutes break. I'll be back and I will continue. I will cover it. After adjustment of inflation and taxation, we will be covering all these topics in the next class. And in the next class, I'm telling you, once I am done with it, in the next class, I will go take you to the kit and solve a past paper full-fledged question. Okay. So yes, there is a topic annuity perpetuity. Okay. There is a 30 minutes revision video. It is from your old studies. Okay. But I will give you 30 minutes revision video. I will give you on that. Okay. So that you can prepare that well. Okay. So annuity and perpetuity, what is that? Old concept it is. So adjustments of inflation taxation in 5 minutes time, I will start. Just 5 minutes break. Now, the point is adjustments of inflation and taxation. Let us talk about inflation. Inflation, we everyone know what is inflation. Inflation is increase in general price level, right? Inflation impact on this on investment appraisal techniques. So cash flows basically. So they have impact on cash flows and impact on cost of capital. Both. Impact on cash flows and impact on cost of capital, both. So cash flows are called real cash flows, which are without inflation. They are also called cash flows in current terms. Today's price term. They'll call real cash flows. Then there are nominal cash flows or money cash flows, where what they are. So nominal or money cash flows are those cash flows which are inflated cash flows. Inflated. Okay, one thing, inflation is one is called general inflation and the other is called specific inflation. That would be clear. General inflation is that inflation. General inflation is that inflation which is average in the economy calculated by, normally they say, central banks say the economy has an inflation of 4%. So it is basically weighted average inflation calculated on a bucket of uh, daily necessities of life. Bucket is calculated. Okay, now. So that is called general inflation. Specific inflation, we say the price of wheat increased by 10%. So that is the specific inflation of wheat. We say the price of the labor cost increased by 15%. So that is the specific inflation of labor. Okay, so specific increase in the price of a specific item. That is called its specific inflation. Next. So cost of capital, real cost of capital and nominal or money cost of capital. So real cost of capital is the same again without inflation. It is without inflation. It is inflated cost of capital. So there is a relationship which is, there is a Fisher's formula which tells the relationship between the both. What is that? 1 plus m equal to 1 plus r into 1 plus h, where m is equal to money cost of capital, r is equal to real cost of capital, h is equal to general inflation. Fisher's formula. So what we do in AFM level, we inflate all cash flows wherever relevant using specific inflation rates and then discount net Nominal cash flows calculated above using nominal cost of capital or money cost of capital calculated in this way. Simple is that, very easy. Okay. Now, the next is impact of taxation on, yes, impact of taxation. What is the impact of taxation? Tax on the project cash flows again has impact on cash flows and cost of capital. First of all, cost of capital. Very easy. Let us do it first. So use post-tax cost of capital always to discount cash flows unless stated otherwise. Now, what is post-tax cost of capital? Pre-tax cost of capital into 1 minus tax rate. Now, next. The next is cash flows. So cash flows, impact on cash flows. First of all, two impacts: tax payment on taxable cash flows. And the second is tax saving on capital allowance. So first of all, how we calculate? So just see here. Step one. We calculate sales, for example, minus costs. Okay. So then we get taxable cash flows. And we pay tax on that. Less tax. And tax rate is multiplied with them, and that is paid over here. So taxable cash flows into tax rate. But I have kept a row empty. So step two, which is for the tax saving on capital allowance. So what we do is we go in the working. In working, calculate tax capital allowance for each year. Capital allowance for each year, which is also called capital allowance or tax allowable depreciation. For each year. We will learn it with example, don't you worry. And then this becomes less capital allowance. Now this becomes taxable profits. So taxable profits are reduced due to this capital allowance, which we calculated. And then tax payment is reduced, tax saved, tax saving on capital allowance. So tax payment is reduced. Then add back capital allowance, which you have deducted above. You will add back the purpose to deduct it. There was one purpose, to reduce taxable profit and reduce tax payment and incorporate tax saving. Add back whatever you deduct here, you add it back here. And now again they become cash flows. Now, with example. For example, sales of a project are here. Okay, cost of sales. For example, this is the cost of sale. Now, initial investment in the project, that is equal to 2,500. Scrap value is 300. And tax allowable depreciation, that is 25% reducing balance basis. Capital allowance. Tax rate, that is equal to 30%. This is the data available to you. Now, just arranging the data. Okay, now, so we need to calculate, incorporate both adjustment of tax. So we will go to the working of the question below. Working. Capital allowance. Okay. So year 1, 2, 3, and 4. Written down value at the start. How much it is? 2,500. At the start of year 1, capital allowance, how much it is? 25%. This into 25%. Reducing balance basis. Now, the next year, written down value, this minus capital allowance charged. So capital allowance, this into 25%. Now, the next is, once again, written down value, this and this into 25%. What is written down value? This minus this. Written down value last year minus capital allowance charge. So in the final year, scrap value is how much? 300. The whole will be charged. So this minus scrap value. This is the capital allowance calculated. Okay. So what we will be doing? Less capital allowance minus this and here. Now, just focus. Taxable profits. Here we are. Taxable profits less tax rate, which is 30%. For example, it is in the same year. Whatever, if they say in a year, we have to pay for tax for year 1 into 2, for year 2 into 3. Okay, let us do it. Tax in arrears. Okay. Done. Okay, in arrears. So this into minus 0.3, 30% minus, because it is payment. Simple. Year 5 will be added. So now these were the two adjustments. Now add back capital allowance. The purpose is served already. Tax amount is reduced. There was another method you used to study in F9 that is also relevant. But in AFM, we prefer this method. Okay. So just give me 1 minute. I'll be sharing with you this file. Just a minute, please. Because we have done today's task. Yes. Please download this file. Have you done it? Have you downloaded it? All right. So, students, we will be meeting in the next class. And in the next class, the targets are a bit